markets finally sustain some real damage. Not surprisingly, we have the first bit of Fed-related news immediately on the horizon. I'm going to unpack what happened today, why it seems that happened, and where we go from here as this event risk looms. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And we're going to begin with a look at the market performance today and what all of it seems to be telling us, and then get into episode 1 of this week's Fed back-to-back event risk, the minutes from July's FOMC meeting. Of course, episode 2 will be the speech from Fed Chair Powell at the Jackson Hole Symposium on Friday, but more on that later this week. So let's focus on first things first here. The S&P down just about 0.5% today. NASDAQ down almost 1.4%, and a very clear kind of risk aversion flavor to markets here. Dollar up for the most part, with the exception of the yen, another usual risk-off beneficiary. So down against the yen, but up against the euro, up against the pound, and really scoring its biggest gains on currencies not on the screen here, the Australian dollar, the Canadian dollar, those things that are tied to cyclical considerations. Those things that are the most sensitive to what stocks are doing and the most sensitive to risks to the business cycle, namely recession risk. Moreover, interest rates are down, and especially so at the long end. Interest rates down for the 10-year, down for the 2-year, crude oil down, gold down against a backdrop of a stronger dollar, despite weaker yields. Bitcoin, of course, the sort of risk sentiment on steroids asset of the mix on the screen here, down almost 3%. So what happened here? Well, the sea of red does seem to be at least somewhat related to comments from OpenAI CEO Sam Altman that said that AI is in a bubble. But how unusual is that really? We don't have CEOs historically in the business of talking things up. No, usually they're in the business of talking things down. And that's, of course, because they would like to under-promise and over-deliver. So when we look at those comments and consider sort of how much credence we need to be giving them, the real question isn't so much whether those comments are to be taken at face value or whether they're the thing that actually drove markets today. The question is, why did the markets choose to respond? And it's the fragility of the environment absent those comments that really sticks out in that sense. It certainly wouldn't be the first time that the CEO of a company tried to tamp things down so that expectations could be bested later. Rather, it seems like, not surprisingly, we are back to Fed watch mode, and that was the real catalyst here because we have critical event risk on the horizon in less than 24 hours. So consider the positioning here. This is the S&P 500, and there's two things to really take away from this. The first is that right here was last week's only meaningful move, and that was the US CPI report. In the 3 days after that data, the S&P went absolutely nowhere, and its net change, but for this, it's basically nothing. In these 3 days, the S&P moves a grand total of 0.05%. And then when you look at what happened in this move today, what you see is that you had this high here. There was a breakout through that high here. And on today's move, that breakout has been clearly overturned. It's not very much different in the NASDAQ. You again had a high right here. You broke that high on CPI. In the days after CPI, NASDAQ actually fell down about 0.5, 0.6%. And then you get this sell-off today and undo the breakout. So if there was a sequencing here, let's say similar to this, where there was a pullback, here was a high, you broke that high, and then you found momentum to the upside, here, a similar attempt fizzles. Here, again, there's a clear resistance line here where there was an attempt at a breakout. That attempt is successful right here, and there's follow through. Similar here, range, breakout, follow through. Here, you have that breakout. It holds briefly and has now failed. It's the same thing here. This has now failed. So what is it about this that was so specific that it hurt market sentiment to this extent? Because it seems like a stretch to say that this was just Sam Altman. As far as Fed rate cut odds ahead of this event risk, we have generally an unchanged picture. Yesterday we were at 83.16, 83% chance that we'll get a rate cut in September, 16% chance that we hold. Now it's closer to 85.15. So the actual probability structure for September's meeting hasn't changed all that much. But that's hardly the object of speculation. As we can see here, the markets have been hovering at about 50 basis points, give or take, going all the way back to May. So, and that, of course, lines up exactly with what the Fed wrote down for their summary of economic projections in June, which is the last time they updated this thing. The current median rate for Fed funds, we can see that the range here is 4.5 to 4.25. The median there is 4.4. 4.4 down to 3.9 is a 50 basis point cut. Well, that's there, and the market agrees that that's where we need to be and has generally held there for the past 3 months. The controversy, the speculation, is occurring here in the outlook for next year. And here, over the past several days, we can see we've actually unclenched a little, where the market is less so convinced that it is going to get as much easing as it did, let's say, a week or 2 weeks ago. At that point, we were looking at 125 basis points because for this reading here for next year, we were at fully 75 basis points priced in. We've been coming in and we came in a little bit more today, down to 66 basis points. So we've said that a rate cut cycle for next year now is 2 cuts at least, but the third is only about a 60%, 65% chance of occurring, whereas very recently here, that third cut was fully priced in. Moreover, we can see the Fed's own outlook is for a single 25 basis point cut. So the market is clearly saying they want more cuts than the Fed has said. So the markets want more easing. So if there is a shift where that more easing is diluted in its probability, well, the markets aren't going to be happy. And it's not surprising then that before we see the release of minutes from July's Fed meeting, the first inflection point in this Fed story this week, the markets are going to feel like maybe if they're one-sided, they need to even out the deck a bit. Now, we know why the markets are so jumpy in the face of all of this. Again, we can see it in the price action. When the Fed news flow is relevant, then we get some kind of action, and outside of that, nothing. So clearly the markets are paying attention to one kind of thing here, but it is important to consider why. Now, we know, again, why the markets cheered that CPI report. It was refreshingly normal looking. Most inflation still in services, goods inflation higher in its contribution, but not running away seemingly. And the headline number was expected at 2.8 and came in at 2.7. And even though the core was expected at 3 and came in at 3.1, the market seemed to really latch on to this bit to say, well, that's not so bad. Maybe we really will get our rate cuts. Incidentally, that's despite goods inflation going up, services inflation cooling. But that we didn't find follow-through later seems to be linked to what we saw in producer prices, which jumped and did so because producers' margins expanded by the most, incidentally, in almost 3 years. And that suggests that tariff costs are now being passed down to consumers. And that's the kind of thing that might keep the Fed from going as hard on rate cuts as the markets want. That, of course, still leaves the question, why do the markets want those rate cuts so badly? Well, we know that there is an emerging threat to growth. In fact, even Chair Powell himself acknowledged as much after the July meeting at the press conference. We likewise know that the tenor of this conversation seemed to deteriorate a bit. This is the statement from that July meeting, and we can see that policymakers pointedly took out the bit that says economic uncertainty has diminished. Moreover, we know that there was a break from consensus. For the first time since 1993, 2 Fed governors preferred the more dovish outcome and voted for a cut. And so, not surprisingly, the question for markets here is, does this suggest that there is a dovish consensus from July that's taking hold here? If the Fed was already getting closer to cutting rates, and if we already have dissents on the committee saying the economy has deteriorated enough that we need to make this move, what has the evidence shown us since? Well, the evidence has continued to go in this direction, even as we get these signs of inflationary pass through and consumers starting to take on these concerns. We just saw last week that consumer sentiment weakened as inflation expectations rose. And this really speaks to what the markets want and why they want it. As we've said many times before, global growth is primarily powered by 3 economies: the US, the Eurozone, and China, that account for 58% of global GDP. The remaining 42% are mainly vendors to these 3 and depend on them for demand. So it's really on these 3 economies to make or break global growth. And so if the markets were to consider that there is some sort of growth concern, well, then, not surprisingly, they'd want rate cuts, and sure enough, that's exactly what we have. Of the three major engines, looking at the latest PMI data, we see the Eurozone and China are at standstill. As ever, these are centered around 50, where that's neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. That the Eurozone and China numbers here are hugging 50 tells you that those economies are barely moving. The U.S. economy seems to be carrying all the weight. We saw that last year. There was a bit of a spook here, obviously, at the start of the year with the tariffs, but it seems like we're back to relatively strong U.S. growth, looking at least the S&P global version of this data, which is what we're looking at here. But if we consider where sort of timelier data has moved since then we can look at the ISM version of the very same data, as we've done here before, also a PMI report, and we can see that on this measure, we're at standstill on U.S. growth, suggesting that already there is the risk that if this is the only leg of the stool that's keeping things standing, it is already fading. Moreover, of course, we saw in the second quarter GDP numbers that consumption, which is 68% of overall GDP, was the weakest for the first 6 months of this year in 5 years, going back to the 6 months that were the COVID recession in 2020. We also see the apparent absence of demand, because whereas in the first quarter imports surged, which would mean that they're a larger negative pull on GDP. Imports are typically subtracted from GDP. And inventories surged as those imports went into stock piles to try to get as many goods at the pre-tariff rates as possible and keep consumers as insulated from those tariff costs for as long as possible. In the second quarter, imports collapse. That's them being a positive contribution now. And inventories go down. So those inventories are being spent and they're not being refilled. In other words, demand is expected to be weak by the people that expect to sell into that demand. And that's despite the fact that in the second quarter, you still have pauses on tariffs in place. So you could still be front-running tariffs at that point and filling up inventories with relatively cheaper goods. But that isn't happening. So we already see that the view on demand is soggy, and we already see that it's soggy in the most important part, consumption. We likewise see that as this pass-through of inflation starts to happen, as we just saw, consumer sentiment is souring, suggesting that going into the third quarter, the consumption picture isn't going to be that much better. And that, of course, brings us back right here. If this is stuck, and this is stuck, and this is the only thing that's working, except it seems to be starting to misfire, well, then it isn't just the US that needs these rate cuts. It's the world economy as a whole. So it isn't surprising whatsoever that the markets rabidly want them. So even the slightest bit here that would suggest that those rate cuts aren't coming ends up being an action-packed headline, which of course isn't helped whatsoever by the fact that, this is a chart from Bank of America, by at least a range of valuation measures, the market is very, very frothy. This particular valuation metric, and you can pick your poison, there's a sea of these, but this particular one is especially eye-catching, coming at you from Bank of America research here just over the past 24 hours, showing that on a price to book value ratio, we're basically in dot-com bubble territory. And so you start going down the list and start to say, okay, well, if the story was AI exceptionalism, we've done that. If the story was wars in the Middle East and the Russian-Ukraine theater, listless crude oil has told you that the markets aren't really paying attention to those things as macro relevant. And so you start to ask, well, what is holding up sentiment then? It isn't the breakout of peace in either one of those theaters, and it isn't seemingly endless room to run on tech evaluations. So what is it that the markets have to hang their hat on? And the prospect of rate cuts in the face of an economic threat starts to be one of the few things, if not the only thing, left in the quiver. If you start to take that away, if the minutes from this July FOMC meeting suggest that this descent is not the makings of a Fed that is going to jettison its caution and that is going to follow through on this much more dovish view for next year than it has so far owned up to, well, then sentiment doesn't have very much of a leg to stand on. And that's how you end up with days like this and days like that. And that is macro money for today. As ever, we are here right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Chris for Futures Power Hour, Mondays and Fridays, on with Chris and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.